I'm Neil, and I'm the teacher.
And I'm Sean, and I'm the deal maker. Together,
We're the Rise Guys.
Welcome. In commercial real estate, you hear two terms thrown around all the time: IRR and cap rate. They both measure returns, but one is a quick snapshot while the other is the full movie of your investment. Understanding the difference is not just important, it is absolutely critical for passing your licensing exam. Today, we are going to break down both tools so you know exactly when to use each one. When you're looking at a property's potential, are you interested in a single frozen moment in time, or do you want to see the entire performance over several years? Your answer gets to the heart of the difference between cap rate and IRR. On one side, cap rate is our snapshot, a quick, simple look at what is happening right now. On the other side, IRR is the movie, the whole story of the investment's life. These are two totally different tools for two very different jobs. Let us zoom in on the cap rate first. The formula is straightforward. You take the net operating income, the NOI that you expect for the next 12 months, and divide it by the property's current value. That is it. Just two numbers. Think of the cap rate as the return you would get if you bought the property with all cash, no loan involved. It is awesome for quickly comparing similar properties in the same market. But its biggest strength, its simplicity, is also its biggest weakness because it is just a one-year snapshot. It ignores everything else, future rent growth, any of the big expenses down the road, and most importantly, the profit you make when you finally sell. Now let us switch to IRR. This is where the real deep analysis happens. IRR is the actual annualized rate of return you can expect over the entire time you own an investment. It tells the whole story from the day you buy through all the years of income to the day you sell. It looks at cash flows over multiple years, and it captures the time value of money. But here is the key. This is probably the single biggest trap for students on the RECA exam. When you are calculating IRR, there is one mistake that trips people up time and time again. So many students get to the final year and enter the cash flows as two separate numbers, the NOI and the sale price. That is absolutely wrong. The cash flow for that final year must be a single combined number. You take the NOI and add the sale price to get what we call the terminal value. Let us walk through a real calculation. We are buying a property for $5 million and holding it for 5 years. At the end of year 5, we sell it for $5.5 million. In that last year, the property kicked off a net operating income of $250,000. So for the most important part, year 5, we combine the $250,000 NOI with the $5.5 million sale price to get a single final cash flow of $150,000. Year 0 is our initial investment, a negative cash flow of $5 million. Years 1 through 4 have positive but uneven cash flows. And year 5 is that combined terminal value. When you punch those numbers in and solve for IRR, you get 6.82%. That is the true annualized rate of return for this entire investment. And that is the correct answer you would be looking for on the RECA exam. So when do you use which one? Use the cap rate for those quick back of the napkin comparisons of similar properties. It is the snapshot. But for a deep, serious analysis of one specific investment over its entire life, you need the full movie. You absolutely need the IRR. And remember, the biggest trap on the RECA exam is that final year cash flow. Always combine the NOI and the sale price into one single terminal value. Knowing the difference between a snapshot and the full movie is what separates a casual observer from a serious investor. New webinar summary every week. Subscribe so you never miss one.